When people talk about Dubai property, most conversations revolve around capital appreciation, luxury launches, or the next big thing. But if you're an investor who actually understands wealth building, you know this. Cash flow is what keeps you alive, and cash flow pays your mortgage. Cash flow also protects you during market corrections and gives you optionality. So today I'm ranking the top 7 best areas in Dubai for cash flow in 2026 based on real rental yields, tenant demand, liquidity, pricing versus rent reality, and what I'm personally seeing from data, deals, and clients. This is not about hype. This is about which units will rent easily, consistently, and profitably. And again, I'm not an agent. I'm a property investor here in Dubai, and I've invested all over the world. I have my Airbnbs in Bali. I've also invested in Moldova. But now we're talking about Dubai and what makes the best cash flow. So with that, hit the thumbs up button and let's start with number 7. Jumeirah Lake Towers, or JLT, and some selected parts of Dubai Marina. JLT might not be flashy, but for cash flow investors, that's exactly what works. High density residential plus a good commercial mix, constant tenant demand from professionals, especially from those who actually work in the area and they want to also live not very far from their offices. Walking distance to the metro, competitive entry prices compared to Marina or other nearby entries. According to DXB Interact market data on 2025, I've analyzed it all for the most cash flowing areas, and I've noticed that actually investors, most of them are diverging from investing in just new units and are actively preferring older and larger units that can be renovated and they can up the market value for that. And JLT fits this profile perfectly. So based on the January 2026 market update, the typical gross yields are in around 6.5 to 8%, but that is an average. You can also definitely almost double that if you are going to actually actively look into property investing, actively get a unit that is older, want to renovate maybe the kitchens, the bathrooms. That would be probably the biggest changer. And renovated one bedrooms would usually outperform the new stock. There is also very low vacancy if this is priced correctly, and some of the top developers and towers would include the DMCC, Master Planned Cluster, Select Towers, Alsif, Green Lakes, Lakeview. There are many Damak towers as well, so you name it. They are kind of old, most of them, but they really have large layouts and there is really a lot of upside potential if you're getting into a older, larger unit, and you can renovate it very nicely, make it really modern and appealing, and that maybe your residence, you might also rent it out for a better rental yield, or you can even resell it afterwards. So JLT is not really about the capital appreciation, but it could well work, while steady, reliable, and boring cash flow is definitely fitting this profile perfectly. Next in line, we have downtown Dubai, and downtown surprises many people when it comes to cash flow, because yes, the entry prices are kind of high, but liquidity and rental demand are unmatched. You will always find a buyer and you will always find a tenant. So why downtown still works very well for cash flow? It's because it has a very global tenant pool, and anyone who relocates or comes to Dubai, they know about downtown and they will definitely want to at least consider that area. Short-term and long-term rental flexibility, you can switch in between your strategy. If Airbnb doesn't work, you can do long-term rentals. If the long-term rentals doesn't work, then you can switch to shorter. It does have extremely high occupancy rates. It's most of the good towers, they're already fully tenanted, yet the yields are not the highest. It's in around 5 to 6%. You can definitely bump it up if you do some, again, renovation, if you add some more unique things in that apartment, especially if you're doing Airbnb. You really want to make it so it looks much more different from anything on the market, something unique. Maybe you have, I don't know, some cold plunges at the balcony that would make it a bit more unique. You might add some coffee machines or something that will definitely give some better value to the renter. But the effective yield stays very strong because of its near zero vacancy. Top developers in this area are obviously mainly MR because MR built the downtown, including Burj Khalifa, and some buildings include Burj Vista, Boulevard Heights, and most importantly, older MR towers still dominate the cash flow. So again, downtown is not really about max yield, but it's about capital protection and very stable income. Next in line, we have City Walk, and that is a hybrid play. Part lifestyle, part investment. Why City Walk works for cash flow specifically? Firstly, because there is limited supply, and the buildings are mainly low-rise buildings, so that's why you would not really see skyscrapers with too many apartments, and most of the times, those will be fully tenanted. That's why there is also strong end-user demand, because many people actually prefer the low-rise buildings in Dubai versus all the very high, tall towers with long waits for the lifts and many other problems associated to that. And of course, the premium profile of the tenant, that also works and makes it work even better because Meraz is the developer who built City Walk, and they usually build very, very high quality. So that's why both the owners know this, the tenants know it, and there will always be demand for it. So for cash flow, City Walk is perfect, and just nearby the AFC is more or less the same, but for lower cash flow profile, so you won't have as much rental yields as in City Walk, but it's really good for capital preservation, especially for professionals and executives working in the financial center. There will be always demand for rentals, and you will definitely have some really long, stable cash flow. The yields in City Walk are at around 5 to 6%. So again, it's not the highest yields. You can really bump them up if you, again, make the apartment look a bit more appealing, more unique and diverse comparing to all the rest. However, it's definitely gonna get you that cash flow. You will not have any issue finding the tenants. So that is why I picked it. Rental stability is extremely high. That's why it makes it a really top choice for the cash flow. So overall, this is not an aggressive cash flow. It's more of like a defensive income with strong capital preservation. Next in line, we have Al Jadaf, which is one of the most underappreciated areas in Dubai, at least in my opinion, specifically for cash flow. So why does Al Jadaf stand out? It's because of the proximity to downtown Dubai Creek and Healthcare City. It's literally in between, and it takes 10 to 15 minutes to go to any of these. Strong demand from professionals, hospital staff, and many other people who just don't want to overpay for downtown or even Business Bay. It's still a bit cheaper than Business Bay, but it will definitely be there, and it's really being built now. Some of the main developers that are building there is Bengati, but there are also buildings from Ellington and some other boutique mid-rise buildings. So here the typical gross yields will be at around 7 to 9%, but you can really make it higher, especially if you get a mortgage and you will leverage that out so someone else actually pays for your mortgage payments. You will definitely make a better percentage return. And I mean, I have many videos explaining how this works, and you can check them out on my channel. But just briefly, when you get a mortgage, especially as a resident, the down payment is 20%. So your ROI is actually calculated based on your down payment, not on the overall investment. So not on the overall price of the property. That's why if you only put out 20% and the mortgage payment monthly is actually covered by your tenant, plus you get some extra profits, this will definitely bump up those percentage yields. Studios and one bedrooms rent extremely fast because this area is mainly for single professionals or just small families who are either just relocating to Dubai or just prefer to be in very close proximity to their work. Number 3 for today is Meydan, and this area has evolved significantly over the past few years. Meydan is really improving for cash flow because mainly people are actually starting to like the area as a residence. So many of the Dubai residents who previously maybe lived in downtown or Business Bay are now moving to Meydan. There is new infrastructure, there are new builds with better amenities, so definitely as being also in close proximity to downtown and Business Bay, people start to prefer it. There is growing tenant demand from professionals working within that area or just within the close proximity. Typical gross yields are at around 6 to 7%. However, I've seen much higher returns, especially if you buy in early. Let's say you want to buy in an off plan at a very good rate. I mean, that is kind of hard nowadays, but if you find some good deals in there, then you can wait for another 2-3 years until it's handed over, and then you basically rent out at the really high rental prices that are currently in. So you will definitely make it up for maybe around 10 to 11%. Comparing to some of the previously mentioned areas like JLT, this area is really outperforming on the new stock and pretty good layouts. Top developers in this area is Shoba Group, Ellington, Select, but also there are Maidan, other smaller developers. So it balances growth plus improving cash flow. So it's 2-in-1. Basically, you might have good capital appreciation in the future when everything is completed, but you also have stable and increasingly better cash flow. This is exactly why it ranked up pretty high and is really climbing up higher and higher. And I'm personally looking at the area. It's really interesting to observe what new developments are being launched in there, especially from Shoba. Also, we had Imtiaz recently launching a Zaha Hadid building there. So definitely much more is going on and is going to be happening in there. Quick note before we move on. Now, a lot of you actually ask me how I approach these projects in practice, especially when it comes to filtering from the good areas, good projects, and the bad ones. For the past few years, I've been working closely with WIM Real Estate, and what I generally like about them is that they cover all these areas that are really good for cash flow, but also for capital appreciation. Not just one niche and not focusing only on one developer and trying to push that. For example, recently we've been reviewing future potential cash flowing off plans that are being launched in Maidan. One was the Ellington Riverside, for example, a strong mid-rise option with better layouts and of course end user appeal, because we know the Ellington buyers are usually coming back and also the tenants really like it. There was also the newest launch in the Shoba 1, so the Element building, which was really stunning. So that one definitely was one not to miss. So while I wouldn't pitch all the Shoba projects, this one was something really stunning and very unique comparing to the whole portfolio. So whether that's apartments in Business Bay, Creek Harbor, or Maidan, lifestyle driven projects and villas in the Maidan bigger master plan, or higher quality tenant-friendly buildings from developers like Shoba and Ellington, WIM Real Estate is active across all areas that I'm ranking in today. I'll leave all their details below, so if you're exploring this location seriously, it helps to work with people who understand cash flow, not just simple launches. Nevertheless, you can also reach out to me directly, book a one-on-one call, and we'll discuss all this in details. All right, let's continue. Number 2, for today, we have Dubai Creek Harbor, and that is again primarily for cash flow. Dubai Creek Harbor is no longer the future potential. It's a functioning real rental market. So why does Creek Harbor work? Mainly because the primary island is almost fully built. There are only 2 buildings that are being finished right now, and outside of that, there is no construction whatsoever on the primary island. And because it's also waterfront, you have downtown views, that makes it a really good packaging deal for a tenant, because they don't want to have the noise from construction, they don't want to have the dust, and they also want to enjoy a friendly, nice community with greenery, with pet-friendly buildings. So that is everything in this island, the primary island of the Dubai Creek Harbor. There is the new metro plan and strong end user migration. So many who have been living in downtown, Business Bay, even City Walk, and even Marina are actually now moving to Creek Harbor because it's just fully built, it's fully integrated, many restaurants have opened, and it's now very livable comparing to many years ago when Creek Harbor was kind of far. You weren't sure if you want to actually move there and have some compromises, So now definitely that is out of questions and people are definitely sticking to the area. Many are actually owners basically new buyers who buy here and actually stay and live in their own apartments. That's why for Cashflow is really, really a good cash cow. It doesn't have, again, the highest yields. I would say it's in around 5 to 6, maybe 7%, just because the prices have really increased significantly. And also if we compare with the off plans that are being launched, it's actually already higher than the ready stock. So if you're looking into Creek Harbor, probably the ready stock and all the units that are being completed already, they are the most appealing for you, and you can actually either move in or rent them out straight away. It still has better pricing comparing to some of the downtown buildings and the waterfront communities somewhere else, like the Blue Waters. Blue Waters is really expensive, although super beautiful and super niche. Nevertheless, the master developer of this community is obviously MR. So you have different buildings, from more expensive buildings such as the Grand Palace, Vida Residences, to more high-end buildings such as the Edge or Harbor Views or Creek Horizon, to more mid-scale buildings as well, such as Creek Rise or Creekside 18, and many more, also townhouses, you name it. Basically, you have it everywhere. That's why Creek Harbor is ideal for investors who want decent cash flow and really very long-term tenants. Also, long-term capital appreciation, because the more it's being built outside of the primary island, so more into the mainland, for the bigger master community that they are planning, the long-term appreciation will also come. Number one, the undisputed king for cash flow, it's still Business Bay. So why Business Bay is number one for cash flow? Firstly, because it's a massive tenant demand, central location, but better pricing than most of the downtown units, huge rental liquidity, and mortgage friendly for leverage. So if you're getting a better priced unit comparing to downtown, but the rents are kinda the same, then you will definitely have a higher yield. You will also have more tenants that will desire to rent from you because the price is slightly lower than downtown, but the location, it's kind of the same. And the very interesting observation that I had while I was researching all the data for 2025 on DXB Interact was that the median ready price for a one-bedroom in Business Bay in 2025 was at around 1.4 million dirhams, while the median price for an off-plan one-bedroom in Business Bay was at around 2.2 million dirhams. That price gap proves the point that some of the off-plans in some areas in Dubai are really overpriced, and that's exactly why ready units in Business Bay are outperforming the off-plans. Now, the typical gross yields in Business Bay, just according to the data, are at around 7 to 9%. Some renovated units, especially from the older ones with better, bigger layouts, definitely exceed this. And of course, if you're doing it through a mortgage, you will definitely have something in around 11 to 14%. Top developers in this area, at least for the cash flow, is definitely Damak, Select, and some specific buildings from Omniat. Business Bay is definitely where cash flow, liquidity, and performance align perfectly. So if you're looking for something that will really perform well long term, and you will always, most of the cases, you will have a tenant, at least if you're renting in the higher season, you will have a tenant probably next day. And if you're actually offering some good value, if you maybe renovate the older units and make them more appealing, you will always have a good cash flow return. So some of the takeaways for 2026 in terms of cash flow are that cash flow thrives in high density areas and well-connected locations. Older units with high upside potential, especially when renovated, might outperform the newer units. Off-plan is generally becoming overpriced versus the ready units in the high density areas. Not saying about the really unique off-plan in more of newer areas such as Maidan, where probably off-plan would make more sense. But if you compare it to the older high cash flow areas like downtown and Business Bay, that's probably where you would still prefer the ready unit. Mortgage leverage plus strong rental demand equals superior ROI. Besides that, not only ROI, if we go into really financial details, the IRR, which is the internal rate of return, and considers your principal that is actually being paid every time you pay your monthly mortgage payment. And if that is tenanted, then your tenant actually pays it. So the actual real rate of return will be definitely higher, because you're also, besides paying your mortgage and making some profit over that, you're also paying down your property. Quick note before we wrap up, everything I share here is how I personally analyze the deals, but your numbers, eligibility, risk level can change the outcome completely. That's why I offer one-to-one advisory calls. We break down your numbers, run scenarios, and decide what actually makes sense for you without any bias, without pushing any kind of projects. If you want that clarity before investing, the links are in the description. This is why my focus always comes back for me and also for my clients to areas with high density such as GLT, Business Bay, Dubai Creek Harbor. But we also analyze newer areas. We also look into other Emirates such as Abu Dhabi, Ras Al Khaimah as well. So we can also consider that. Nevertheless, if you're investing for the actual outcome, not just ego or telling your friends back home that you own an apartment somewhere in Dubai, that really doesn't make sense anymore, then this framework will work for you. So reach out and let's see which cash flowing area is best for you. Nevertheless, I hope you like this video. If you want to see more, subscribe, and I'll see you in the next one.